Since the invention of Bitcoin in 2009, hundreds if not thousands of other cryptocurrencies have been introduced. Most are clones of Bitcoin and share the same operating principles. Proponents claim that cryptocurrencies empower individuals by decoupling money from banks and Wall Street. However, the crypto industry is highly volatile and largely unknown. The origins of cryptocurrencies. Cryptocurrencies are a revolutionary new form of money that operates on blockchain technology. Bitcoin is a household name, and the total cryptocurrency market cap has reached trillion-dollar valuations. But what is the origin of cryptocurrencies, and where are they headed? The first digital currency, Bitcoin, was created in 2009. Since then, a growing number of other projects have been built on the same foundation. These include Ethereum, which launched in 2015 and introduced the concept of smart contracts, programmable agreements that execute automatically when certain conditions are met. These innovations have opened the door to decentralized finance, DeFi applications that aim to offer financial services without the need for traditional intermediaries. As the popularity of cryptocurrencies has grown, so too has their volatility. The price of a single Bitcoin has been known to rise and fall by hundreds of % in the space of just a few days. Cryptocurrencies also face regulatory challenges. While some governments have adopted pro-crypto stances, others are examining their implications for consumer protection and financial stability. While there are a variety of opinions on whether cryptocurrencies will be transformative or just a fad, one thing is clear: they have created an enormous amount of interest. According to a recent study by the Pew Research Center, 16% of Americans say they have invested in or traded cryptocurrency. The roots of modern cryptocurrencies date back to 1983, when American cryptographer David Chaum published a paper detailing an early form of anonymous cryptographic electronic cash. In 1995, he built on his ideas to create DigiCash, a prototype system that used encryption to allow users to send funds untraceably. The 2008 economic crisis brought public trust in traditional banks and financial institutions to a low, and it was at this point that the concept of a virtual cryptocurrency gained momentum. Bitcoin. Cryptocurrencies are a trillion-dollar industry that inspires passionate opinions. To proponents, they're a democratizing force that wrests power away from central banks and Wall Street while empowering individuals and communities. But critics point to massive market volatility, a lack of consumer protections, and the fact that they require immense amounts of computing power to function, making them high-risk investments. The modern era of cryptocurrency started with Bitcoin, which launched in 2009. While pioneers like David Chaum had introduced secure electronic cash systems in the 1980s, they were limited by their centralized design. Bitcoin and other cryptocurrencies are decentralized, built on blockchain technology, and nearly impossible to counterfeit. While there were some digital currencies in existence before Bitcoin, they didn't achieve widespread adoption. In 2009, Bitcoin's creator Satoshi Nakamoto mined the first block and sent the first transaction using the coin. Software developer Laszlo Hanyecz later made the famous purchase of 2 pizzas for 10,000 Bitcoin, a transaction still celebrated today as Bitcoin Pizza Day. In just a few years, cryptocurrencies have gone from obscure online fads to trillion-dollar technologies. But the future of the nascent industry depends on how governments regulate it. Many regulators are grappling with the question of whether cryptocurrencies are securities, which would require them to meet stricter regulatory standards. Some analysts predict that this could ultimately kill the industry, while others see a path to greater regulation that would protect consumers and encourage innovation. Whichever route is taken, the rise of cryptocurrencies is sure to have a major impact on our global financial system. Our infographic takes a closer look at the evolution of this powerful new trend. Altcoins. As the name implies, altcoins are every cryptocurrency that's not Bitcoin. Some of these have been created as alternatives to Bitcoin, while others are unique digital currencies with their own specific use cases and technologies. In order to differentiate themselves from Bitcoin, they often offer different features such as a different consensus algorithm, varying distribution methods for tokens, faster or slower transaction processing speeds, and other improvements on the blockchain. While there is a lot of speculation about how many altcoins will survive in the long run, it's likely that some will find success. In order to thrive, an altcoin needs a clear user and business adoption case, a solid technical base, and continuous innovation. These features will help it to evolve and grow along with the broader crypto landscape. The current crypto market is experiencing a wave of altcoins. While the majority of these have a low market capitalization, some are making huge gains in popularity and prices. This is known as the alt season. These gains are largely driven by media attention, and as prices rise, more people begin to invest in them. However, it's important to remember that these cryptocurrencies are still very new and volatile. Therefore, it's best to diversify your investments and not put all of your eggs in one basket. If you're considering investing in a particular altcoin, be sure to do your research and read all documentation thoroughly. Also, be sure to talk to a financial advisor who is familiar with cryptocurrencies. For additional resources, check out Investopedia's Guide to Cryptocurrency Investment Strategies. Stablecoins. Stablecoins are digital assets designed to maintain a predictable, unchanging price. This makes them ideal as a digital bridge for settling transactions between traditional currencies and crypto assets, or for hedging against price fluctuations in crypto markets. They also play a vital role in the systems that underpin the trading and use of crypto assets by providing stability and trust. There are several different types of stablecoins which are backed by a variety of fiat currencies or commodities. Some are fully or partly collateralized by real-world assets, while others are non-collateralized and purely algorithmic. In the latter case, stablecoins are backed by a self-sustaining economic system that expands and contracts their supply based on an algorithm which may be influenced by factors such as interest rates or market volatility. The stablecoin industry is developing rapidly, with over $100 billion worth of coins currently in circulation worldwide. This is a big number, considering that the total value of the global crypto ecosystem was just over $800 billion at the beginning of 2022. The growing adoption of stablecoins is due to their low price and high liquidity, making them an excellent choice for day-to-day transactions. These transactions include commercial payments between businesses in different countries, remittances, and foreign exchange services. There is also a growing trend for stablecoins to be used as store of value and hedging instruments. Despite this rapid growth, it is important to remember that stablecoins are not immune from risk. Each one is susceptible to market, credit, and liquidity risks, as well as the risk of a rapid withdrawal of funds with redemption compromised by illiquid reserve assets. The three largest asset-backed stablecoins have experienced crashes, all of which owe their origin to a single event: too many investors piled in to buy them. Regulation. The popularity of cryptocurrencies has caught the attention of regulators worldwide. They are examining their implications for financial stability, consumer protection, and money laundering. Some countries have adopted pro-crypto stances, while others have banned their use. Cryptocurrencies have also been criticized for facilitating illegal activities such as money laundering and terrorist financing due to their anonymity features. This has led to calls for stricter regulations and the development of privacy-focused cryptocurrencies such as Monero. Bitcoin and other cryptocurrencies are one possible path to replacing government-controlled centralized money with a distributed alternative that is controlled by nothing but market forces. But many questions remain. Will this new technology succeed in delivering the promise of financial autonomy to nearly 2 billion would-be consumers who do not have access to banking services? And what will it mean for our global financial system? As cryptocurrencies have gained in popularity, they have evolved from digital novelties to trillion-dollar technologies with the potential to revolutionize the world economy. They are used for a wide range of purposes, including investing and buying goods and services. But they have also attracted the interest of governments, which are seeking to capitalize on this new technology by launching their own cryptocurrency. The neutral model fits the observed patterns of cryptocurrencies well, but does not capture all the complexity of the cryptocurrency ecosystem. For example, it does not account for the fact that some cryptocurrencies are better suited to particular uses than others. Future work will try to incorporate this in the model. In addition, the current model does not account for the fact that cryptocurrencies are often traded on exchanges with different liquidity. In some cases, this leads to large price swings and high volatility,